Hey everyone, James Ananon here with Pillar 6 Advisors. Today is May 7th, 2021, and welcome to our monthly outlook for the month of May. There's a lot to cover in this, of course, from taxes to inflation and also what's driving returns in the equity markets. So I'll go ahead and get started. Right in the beginning of the year, there was a shift moving from the growth-oriented companies to value-oriented companies, and a lot of that shift came when interest rates started to spike higher, at least on the 10-year yield. And there's a big sell-off in the bond market, and what that started to do as interest rates went higher, it started to put in question of valuation for companies who are in that growth mode, and those companies are companies that rely more on debt to grow, as many of you are aware. Value-oriented companies don't necessarily have that amount of debt where they're in the growth mode, and so they're looking at increasing their balance sheet, increasing their earnings, and things like that. And so as we went through 2020, it was more about multiple expansion, and it was very favorable for the growth companies. And as we're entering 2021 right now, we're looking at the experience to be more focused on corporate earnings, which is, of course, very important. Future prices of stocks are based off of corporate earnings and how those earning growths continue to happen. Of course, we believe that growth companies are disruptive, they're transformative, they are the future growth, and they will be the winners in the long term. However, that shift to value-oriented companies comes off the back of a long-term expansion within the growth side of it, where value completely underperformed growth for a long period of time. And at this point, we were kind of due for some type of movement. However, we've been due for that movement from growth to value for quite some time, multiple years, in fact. Now, that doesn't necessarily mean that's going to continue, and there's a few factors on that. Growth companies in general can tend to be quite volatile, especially during times where multiple expansion is what we went through in 2020 to this time right now, where we're looking at more about how earnings growth is going to continue to expand. And of course, on the back of corporate earnings, there are some fundamental changes within the landscape of just the economy and how that can affect and shape some of these earnings and equity prices. Of course, there's inflation. We're starting to see that show up in commodities prices, looking at copper, steel, building materials, corn, things like that, even within the energy space. And so that's a very, very important thing to look at. However, if you read through some of the white papers from world governments, they believe it to be transitionary, which means, hey, we just came out of the pandemic, everything was shut down, we had a huge supply chain issue, and we still have not figured out those kinks within the supply chain, so there's shortages within many different commodities. And so they're showing up in commodities prices. They believe that there might be a spike of inflation and then, kind of a normalization of those prices as the supply chain gets working again. That's still yet to be seen. Those are areas that we're definitely watching. We've seen inflation if you've gone to buy gas or to the grocery store, of course. And so we want to make sure that that doesn't get out of hand. And so do they. That's part of their process. The Federal Reserve, as well as all the other world governments, are continuing to increase their balance sheets by buying more debt, which is going to further stimulate the economy. We still have a few hundred billions of dollars that have not been redistributed out to the economy based off of what they have put together in some of those past packages. And so there's still some money sitting out there that can be deployed. Another one that we need to look at here is taxes. Taxes are a big deal with the Biden administration at this point. And really what's happening is the administration is trying to bring in a new bill to really effectively change all of the tax codes that went in 2017 with the Trump administration. And not only just through personal taxes, but also through corporate taxes. On the corporate tax side of it, it's important to remember that there's arguments on both sides of the table. One side says that high corporate taxes force corporations to hire less, wage growth is slower, is smaller, and it increases unemployment. And the other argument says, hey, look, from the past, we've seen that some of the times of the lowest unemployment rates are based with the highest corporate tax rates. And so that's a pretty interesting argument. The main points here about the administration and their tax changes are nobody actually knows what it's going to be when it's all done. there's definitely a push for change on the corporate and on the personal income tax side, as well as capital gains tax side, but no one really knows what it's going to be. I'd venture to say that it's not going to be anywhere near as high as what they are trying to push, at least on the personal income tax side. Perhaps the corporate tax side may have some slight changes to the downside and kind of temper that. However, nobody really knows, and the thing about it is then we may not know anything until we get closer to the end of the year. It seems to me that this is not going to be something they're just going to push through very quickly, because it is raising taxes and may make things more expensive for people who make over $400,000 a year. Make things more expensive for businesses. We are going into a time where we have extremely high unemployment, and we need to start creating jobs. So how are they going to balance those taxes with continuing to create jobs? I mean, they do need to pay for the economic stimulus somehow. Obviously, that's debt, so that's a tax on the future. Debt, that's what debt is anyways. But how do we make sure that they can pay that off? Look, we just came out of a very difficult time, and they're trying to figure out the right way to do this. Are taxes bad on all fronts? Not necessarily. They're not awesome, especially from a personal tax side. However, as things start to move forward from an economic standpoint, they're going to be an important factor of figuring out how they pay back some of these debts. So that's a very important side of it. You have taxes and inflation right now. We say all this to show real issues that are within the economy that can really affect equity prices moving forward. The truth and reality is no one knows exactly what's going to happen in that tax bill, how it's going to come out. There's definitely going to be some changes, though. And as things become more clear, we'll be able to have a better picture of what can and cannot be done. And so, a couple things just to remember is equities are in a transitionary phase. The economy is in a transitionary phase. And we need to remember that when we're making decisions. The markets can be quite convoluted at times and difficult to read. But what we need to focus on is the long term and how that is going to affect our decision-making processes. There's obviously, as mentioned, there's taxes on one side of the board, there's inflation on the other. How does that translate into movement moving forward and our positioning in portfolios? And those shifts happen as we get more clear information on that. We really appreciate all your guys' time. We appreciate your trust. If you're a client, please feel free to reach out to us if you have questions about your portfolio. And then as well, too, if you have questions and you're not a client, we're more than happy to speak with you about that as well, too, and our positioning on the market. Thank you guys so much for your time in advance. I really appreciate it. Talk to you guys soon.